Hi and welcome back to Siren Crypto. I'm Becky and today I'm going to be covering something a little bit different. Now there's plenty of videos out there about trading tactics and there's lots of stuff to read on the internet, and I feel a lot of that comes from a theoretical angle. So for us at Siren Crypto, we thought we can put together a series of videos that offer practical help to all the different aspects of trading. Firstly, here's our disclaimer. This tutorial is for educational and illustrative purposes only. We are not responsible for any investments made applying this information or buying or selling recommendations. Siren Crypto are not licensed investment advisors. We make no recommendations to purchase or sell any kind of coin, option or security. Any investment contains risk and is 100% the responsibility of the investor to assess the risks and rewards involved. Trading the crypto market involves a high degree of risk and you may incur financial losses if you engage in this activity. We at Siren Crypto take no liability, assumed or implied, from your application of the information we share within our training programs. Today we'll start off with what's the most important thing when it comes to trading, something that does get ignored by lots of new traders, and it's how important trading psychology is to becoming a successful trader. If you have done any research at all, then it's no secret that when most people start trading, most end up losing money. It can be really confusing for the new trader because you think, well, hang on, all I need to do is, if I can just get my charts right and get the right sort of indicators, then surely I'm going to have a successful trading strategy. And I think we all learn very quickly that there is a bit more to it than that. I think this is where the psychology comes in. Now, we all end up looking at the same charts, we get the same news, the same events during the day, yet some people make money and other people lose money. So clearly what goes on in our heads is the thing that makes the difference between making and losing money in the markets. There has been lots of research done, and one of the most common mistakes that we make in the beginning is that our losses end up being quite a bit bigger than our winners. If we can highlight these mistakes and we know what they are, then hopefully we can avoid them in our trading. Now maybe this won't be a surprise to you and hopefully it's a relatively easy thing to fix. Let's take a typical trader who's right half the time. So we will assume he's got almost a coin flipping approach to the market. Let's say when he's right, the profit on the account is $50. And then when the trader gets the market direction wrong, as we all do from time to time, the loss is $100. You really don't need a PhD in mathematics to figure out which way the trading account is going to go. Okay, so let's illustrate this on what the profit and the loss is going to look like. Now, the trader starts off with a winning trade and the trade is up $50. The next trade then is a loser and of course it drags the account down. Then we see something of a bounce on the account and he has a winning trade of, let's say, $50. And then the next trade is a losing trade, and so the whole thing goes on. You can see a trend developing, right? One of the reasons plenty of traders find it such a challenge is the simple maths of the losses being bigger than the gains. What we have to try and do is to turn things around. There are lots of cliches in the trading markets. One of the better known ones is that markets are about hope and fear. This is what drives the markets, but it also has a big impact on traders. One of the biggest problems in this situation is when our losses are bigger than our winners. When we have a losing trade, we're hoping it's going to stop and it's going to turn around into a winner. And then we have our winning trade, but we're worried and we have the fear that the market is going to take our profits away. And then we have the classic situation where maybe new traders snatch profits really quickly. You know how this is, you close the trade really quickly as soon as it shows profit. But then we sit there on a losing trade and hope the market comes back. What we have to do, now this is easier said than done, we have to flip that hope and fear part of the psychology in our minds. So when we have a trade that's going in our favour, we have made the right decision for that part of the trade and we should hope that there are further profits to come. But when we have a market that's moving against us, that's not going the way that we thought, then we shouldn't sit there hoping it's going to come back. We should be worried that we've got the market wrong and maybe it's time to take a small, manageable loss. Now's the time to take a look at your own trades. If you've only done paper trades so far or you've actually started live trading, have a look at the breakdown between the average winning trade size and how much that makes you and how much the average losing trade makes you. If you see that your losses are bigger than your winners, then it's something you need to address. This is a really basic part of trading psychology, and hopefully it's something that's really easy to spot. So in this video by Siren Crypto, we've touched on how important these psychological aspects of trading are. We're going to cover this in more depth, so make sure you watch the next video in this series. If you like this video, give us a thumbs up. Make sure you don't miss out on all of our videos by clicking the subscribe button. You'll get notified when our next lesson is uploaded. Well, I'm Becky. Thanks for watching Siren Crypto, and I'll see you on the next video. Happy trading!